Hello and welcome to Chapter 12, and in this chapter we're going to talk about cash flow estimation and risk analysis. So we're going to look at relevant cash flows, different types of risk, and do an analysis of that risk. So up first we're going to look at a proposed project, and we have two choices, 1 and 2. So proposed project 1, equipment purchase price of $280,000. The equipment is eligible for 100% depreciation. After tax cost is going to be 280,000 times 1 minus our tax rate and be 210,000 because we can write that off. Net working capital is going to rise by 25,000 and accounts payable by 5,000. It's going to give us 100,000 units a year of additional sales at $2 a unit with a variable cost of 60% of sales. So this project is going to last 4 years, and our equipment here once again can be fully depreciated. Salvage value at the end is 25,000, meaning whatever's left over with the equipment we can scrap it for 25,000. Our tax rate's 25% and our cost of capital 10%. So if we want to know how we would determine our project's value, it's pretty straightforward. We're going to simply find the present value of all of these cash flows. So we need to first calculate all of the operating cash flows, identify any changes in operating working capital, and calculate any final cash flows, terminal cash flows, salvage value, and any recovery of working capital. So in this case, what is the change in net operating working capital? So our change in inventories was 25,000, but some of it's being funded by increased accounts payable. So in this case, our change in operating working capital is 20,000. So overall, that would mean $230,000 of negative cash flow at the beginning. So how is this going to work? So number one, our revenues from this project for the 4 years are going to be $200,000, costs $120,000. We're not depreciating anything in any of the 4 years because we're doing it all up front. Earnings before interest and taxes are right here. Tax is 25%. Here's earnings before interest and taxes with taxes taken out. So that's after-tax earnings. And no depreciation. So for the 4 years, we have cash flows positive $60,000 for each of those 4 years. Now, what happens at the end? What do we mean by terminal cash flows? Salvage value is what we get when we scrap the equipment we bought. So $25,000, and we have to pay tax on that. We wouldn't pay tax on it if we hadn't fully depreciated it, but since we depreciated it to zero, we wrote it off that it would be worth nothing at the end. In reality, we got some money back, so we pay tax on that salvage value. So we wound up making a profit of $18.75 off of the junk equipment. We get back that change in working capital, so our terminal cash flow is $38.75. So in year 4, our free cash flow is the $60,000 we make from the project plus the $38.75 or $38,750 we get from winding the project down, both scrapping the equipment and getting our change in working capital back. By doing that, year 4 actually is a higher cash flow. It's $98.75 or $98,750. So how do we recover net operating working capital? It's recovered at the end of a project's life. It has no tax impact. Is there always a tax on salvage value? Well, it's considered the difference between salvage and book value times tax. So if they were equal, there would be no tax. But since we fully depreciated this, we said it would be worth nothing. Therefore, we're going to pay tax on that salvage value. It winds up being an unexpected income stream. Is the tax on salvage value ever a positive cash flow? Yes, if salvage value is less than book value, meaning we said the old equipment was going to be worth, let's say, $100,000 at the end, and if it's worth zero, we would actually get a tax write-off for that difference. Should financing effects be included in cash flows? No, because dividends and interest expense are not generally included. they've already been taken into account because we're using our weighted average cost of capital. Remember, when we calculate our weighted average cost of capital, that's what we covered in Chapter 10, all of that is taken into account already. Deducting interest expense and dividends would be double counting financing costs. Since they're already factored into our WACC calculation, we don't actually need to do that. Should a $50,000 improvement cost from the previous year be included? And this is an important point. If you're a company and you're going to undertake whether or not we should go with a project, anything that happened in a previous year does not actually count, because that is irrelevant of the project or not. Whether or not we take the new project or don't, we still spent that $50,000. So whether it was to improve a factory or to buy something or do some kind of research, that was done regardless. So whether or not we choose to do the project or not, we already spent that $50,000 and we're never getting it back. It's known as a sunk cost. Sunk costs are not considered because they are irrespective of the project. Whether or not you do the project, the sunk cost was already spent. So any sunk costs are not included. It should only include incremental investment, not any sunk cost. So if our facility could be leased out for $25,000 a year, would this affect our analysis? In this case, the answer would be yes. Because if we could lease our facility, that's now an opportunity cost. If we go ahead and do our project we're considering, we're foregoing that cash flow of the $25,000, and it's an opportunity cost to be charged. We could just lease our factory, do nothing, and make $25,000 a year. That's an opportunity cost. So our project still needs to be profitable in lieu of that opportunity cost. If it's not, you're better off leasing the factory because it's a guaranteed profit. So the relevant cash flow is the annual after-tax opportunity cost. So if we would make $25,000 a year, we take out our taxes of 25%. So we have to factor in that right there, $18,750. Meaning we need to make more than that as a profit with this project, because if we don't, you'd be better off leasing it. So if we make less than that $18,750, the project actually would be losing you money, because you can make more of a profit by just simply leasing the facility out to someone else. So that's something to definitely consider. If we can use the factory to lease it to someone else, that's something to definitely take into account. If the new product line decreases the sales of our other lines, would this affect it? That's known as cannibalization, and it's a type of externality. So if taking this new project means we have to divert resources away from an existing project line or make less of an existing project, whatever lost sales that is going to cause has to be factored into the analysis. And once again, the new project needs to make us more than what we're losing by foregoing that other part. So the net cash flow loss per year on the other lines is a cost to this project. We need to make more than that change. Externalities can be positive. A positive one could be if we're a computer company and we start making wireless headphones that work with our computers, it should, in theory, increase sales of both. Or it could be negative. We have a factory that makes cell phones and we're going to convert it to make tablets. If we do that, we'll be able to make tablets, but we may now be making less cell phones than before because we had to take one of our factories offline. That's a negative externality. We're swapping one product for another. So it can be positive and it can be negative, depending. So if we want to look at a project here, remember year one we had to spend $230,000 to get the ball rolling. Then we're going to make $60,000 for 3 successive years and $98.75. The easiest way to do this would be use the NPV calculation in Excel. So enter equals NPV and then enter the cash flows in order. Negative 230, 60, 60, 60, and then 98.75. And your appropriate interest rate is your cost of capital, 10%. You would get an NPV here that is going to be negative. Your NPV here is negative $13.34 thousand or $13,340, an IRR of 7.5%, and a modified IRR of 8.4%. Note both of those are less than your cost of capital, and your NPV is negative. All of those things mean you probably would not want to take this project. You have a negative net present value, and your return is less than the money you're using is costing you. In all of those situations, it really would not be a project you would want to do. Payback would be 3.5 years, but remember, payback does not take into account time value of money. That's just straight payback in a nominal sense. when we take into account present value, this project actually is not making us any money. It actually is not profitable. If this was a replacement rather than a new project, would the analysis change? So old equipment would be sold and new equipment would be purchased. We might get a lot of money for that old equipment. So that might change the analysis quite a bit. The incremental cash flows would be the changes from the old to the new situation. Relevant depreciation would be the change with the new equipment. If the old machine was sold, the firm wouldn't receive salvage value. It is an opportunity cost for the replacement project. So keep that in mind if this was a replacement instead of something we were doing from the ground up. So what are three types of project risk? We have standalone, corporate, and market, and we're going to look at all of the following. Standalone risk is generally the project's total risk if it was operated completely independently. Usually measured just like when we look at risk of stocks with standard deviation or coefficient of variation, but it is ignoring the firm's diversification among projects and investors' diversification among firms. No company has one project and one project alone. So once again, this would be if it was operated independently. It's ignoring, however, any diversification of the company. Corporate risk is the project's risk when considering the firm's other projects, so diversification within the firm, and it's a function of both the project's net present value and standard deviation, and also its correlation with returns on other firm projects. Does it seem to do well when the company does well? Does it do well when the other projects aren't? That all is factored into corporate risk. Market risk is what is this project's risk to a well-diversified investor. Generally, it's measured with beta, just like the risk of a stock, and it's considering both corporate and shareholder diversification. Which risk is most relevant? We would argue market risk is the most relevant when we're looking at big capital projects, because what is the primary goal of management? It's maximizing shareholder wealth. But since corporate risk affects creditors, customers, suppliers, and employees, we really shouldn't completely ignore it either. What risk is easiest to measure? Well, standalone risk is easiest to measure, and firms generally focus on standalone risk when they're making capital budget decisions. It may not be theoretically correct, but it does not necessarily lead to poor decisions. So even though that's the risk of this project by itself or in a vacuum, if it looks very risky or very safe, it's a way we can gauge when we're making budgeting decisions. And by doing that, it may not be theoretically correct, but it generally leads to correct decisions anyway. Are these risks generally correlated? Well, yes, since most projects the firm undertakes are in its core business. If you're a computer company, you're going to be making computers and technological products. You're not going to be building cars or toasters or something like that. Standalone risk is generally highly correlated with corporate risk for that reason. Companies generally aren't making projects that are completely have nothing to do at all with their core business, and corporate risk is generally highly correlated with market risk. So they are generally highly related. What is sensitivity analysis? Well, this is an analysis that measures the effective changes in a variable on a project's net present value. To perform it, all variables are fixed at their expected values, except for the one in question, which we can fluctuate, and we note the change in NPV. Advantage is we can identify variables that may have the greatest potential impact on profitability and allow management to focus on them. And generally, we use software to do sensitivity analysis. If you take further business classes, you will get deeper into this. And it's generally analysis you're going to conduct utilizing software where you can vary a variable and see what happens. Some disadvantages, well, it's not taking into account any effects of diversification, and it doesn't incorporate any information about the possible magnitude of forecast errors as well. No forecasting is perfectly accurate. What if we want to evaluate projects with unequal lives? So machines A and B are mutually exclusive and can be repurchased. If our cost of capital is 10%, what's better? So machine A lasts 4 years, machine B lasts 2, but we could buy it again and use it 2 more. So we'll take a look. Solving for NPV with no repetition, we can just simply add the cash flows. I would recommend instead of a calculator, use Excel, equals NPV, and enter your cash flows. The year 0, 1 is the outflow, and then we have year 1 and year 2. Generally, we discount year 1 and year 2 and then add year 0. We do not have to find the present value of year 0 because it's incorrect money. So if we do that, NPV of A is greater than B. But is machine A better? Note, NPV of B is a 2-year long project. NPV of A, it's more, but it's 4 years. So which one is better? We need to use the same amount of time. So we need an equivalent annual analysis. So what do we do here? Since machine B is a 2 and machine A is a 4, the common life is 4. So we're going to look at it as we use machine B where after 2 years we buy it again. So machine B costs us 50 grand. Year 1 we make 34, year 2 we make 27.5. In reality, year 2 is going to be a loss because we're going to buy the machine again. But then year 3, 34, year 4, 27.5 again. So doing this extended analysis, machine B is now going to be 6641. It's going to be 6641. So now we're looking at both of them on a yearly basis. On a 4-year basis, excuse me. If we want to find the equivalent annual rate, we would find what's called equivalent annual annuity. And we're going to want to use Excel to do this as well. So we're solving for payment in both of these. Your function is going to be equals PMT equals PMT. And then we're going to enter for a machine A. We're going to enter for machine A 4 years, interest per year 10%, present value, future value, and it's going to give you your equivalent annual annuity or how much you are providing per year, how much it's earning you a year. Machine B, we can just use 2 now because it's going to take that into account. 2 years, cost of capital is the same. The present value you got before. Note both present values are negative because we would have to purchase it, and now we want to know what it's going to make us. Set 0 for the future value in both cases. And solving for payment, the EAA for machine B is more. So both the present value when we adjusted to 4 years was higher for machine B, and the EAA is higher as well. So it means machine B is better. Just because you have to buy it again and use it a second time, it's going to make you more money even having to buy it again because the cash flows are a lot higher. So if something lasts for a less time, you have to basically conduct an analysis where you're comparing them in the same time scale instead of comparing apples to oranges, one that lasts 2 years and one that lasts 4. If inflation is 5%, is NPV biased? Well, your discount rate already reflects inflation. Higher expected inflation is going to translate into higher nominal rates. So if inflation is higher than expected, it may also lead to changes in your cash flow forecasts. Both the revenues and costs are likely to increase. If those changes have not been incorporated into the analysis, well, then the NPV calculation could be biased. So looking here, if inflation is 5%, what's going to happen? So revenues are going up due to inflation. That's what's going on here. Costs are going up as well. So it's adjusting, the cash flows are shifting. They're getting higher in a nominal sense because of the inflation. So year 1, 2, 3, and 4, that's all due to that inflation. Now, at the end, we still have to worry about our salvage and our change in working capital. And that's what we did here. So here's all of our free cash flows, and we can still calculate everything. IRR, MIRR, NPV. So in this case, this project actually is profitable. You have a positive NPV. And MIR and IRR are higher than your cost of capital. So if we wanted to do a scenario analysis, that's where we chart out what are probabilities of certain things. So worst case, we can sell 75 per year, base case, or what we expect, 100, best 125, and here are the probabilities of all three. So we're confident of all of our estimates, but maybe sales we think are going to be variable. So if we do that, in the worst case, we have a very negative NPV. The best case, we have a positive NPV. Excuse me, in the base case. And in the best case, we have a highly positive NPV. So if we want to determine what do we expect to happen, it just is a weighted average. So we find the weighted average of all three cases, 25% the worst case, 50% the base, 25% the best, and it gives us an expected NPV just by doing this. We're finding a weighted average here. Of 10.4. That's our expected NPV. Now, also, we can find the standard deviation. That's being done right here. And we can find our CV of our NPV as well. And that's going to be 3.6, our coefficient of variation. That's simply standard deviation divided by the expected NPV. So in this case, we would expect a positive NPV taking into account all of the scenarios. Of course, if the bad scenario happened, the worst case, we would lose money. But probability-wise, we would expect a positive NPV. This would be a project we would go ahead with. So if a firm's average project's CV NPV range is 1.25 to 1.75, would it be high, average, or low? So with a 3.6 coefficient of variation, we would say this is a high-risk project. So maybe some risk correction is required for proper analysis. We would say this is a high-risk project. We may have to adjust for it. So is it correlated with the firm's business, and how would it contribute to overall risk? So we would expect a positive correlation with the firm's aggregate cash flows. As long as correlation is not perfectly positive, we would expect it to contribute to lowering the overall risk. Why? Diversification. If the project has a high correlation with the economy, how would corporate and market risk be affected? Well, corporate risk really wouldn't be affected, but when combined with the project's high standalone risk, we have a really high coefficient of variation. Correlation with the economy would suggest we have a high beta. Remember, if you have a high standalone risk, and if it's highly correlated with the economy or the market at whole, you would get a pretty large beta. It would be riskier than the market. If a firm uses a plus or minus 4% risk adjustment for the cost of capital, should it be accepted? So if we're adjusting plus 4% because it's high risk, we would now have a negative NPV using a 14% cost of capital instead of 10%. So we would not take it. If it was a low-risk project and we use 6%, it would have a 35.09 thousand positive NPV. We would take it. So remember, cost of capital varies based off of risk. So that has to get factored into the analysis as well. And finally, what subjective risk factors should be considered before we make a decision? Numerical analysis sometimes fails to capture all sources of risk for a project. It's not necessarily possible to distill all risk down into numbers and equations. If the project has a potential for a lawsuit, so if, let's say, there's a chance this product might get recalled or hurt someone or cause environmental problems, if any of that is possible, it's more risky than previously thought. So, very important point. If assets can be redeployed or easily sold, we would say the project may be less risky than otherwise thought. So keep those two things in mind as well when considering a project. Not everything can be distilled down into numbers. With that said, that's going to take us to the end of chapter